Hello, everyone, and welcome to SCORE Fairfield County's live webinar on financing a small business. I'm Tim Ryan, the webinar coordinator and a business mentor here at SCORE Fairfield County. I'll be your host. Our sponsor today is First County Bank. I see Greg Pastor from the bank is on the line. Greg, would you like to say a few words?
Yes, thank you, Tim. Hi, everyone. My name is Greg Pastor, and I am Vice President, Commercial Banking Officer for First County Bank. Thank you so much for participating in the event today, and it's an honor to work with SCORE. You will walk away with a lot of valuable information today. Just to give you a bit of information about who we are and what we do, I'd like to start by stating First County Bank is a mutual bank that has been around for over 170 years, serving our local community. We're close to $1.9 billion in assets, and we have 16 branches located throughout Fairfield County. We also have a First County Bank Foundation, which was started in 2001 and has donated over $10 million year to date to local nonprofits. We offer a variety of products starting from personal banking to wealth management. I specialize in commercial financing, and I'll have SCORE provide you with my contact information. Please feel free to reach out to me if I can be of any assistance to anyone. Thank you so much for the introduction, and now let's get started with today's session.
Okay, Greg. Our presenter today is Joe McCaffrey. More on Joe in just a minute. First, some brief info on SCORE. There's over 320 offices and 11,000 volunteers nationwide. We're part of the SBA. SCORE Fairfield County has over 100 volunteers with a wide range of industry, process, and subject matter expertise. We offer 3 primary value-added services to small business owners. First, free one-on-one counseling. Second, educational workshops and webinars, over 100 per year. And third, we have extensive resources on our website, including Word and Excel templates to help you build your business plan. SCORE puts on many webinars each month. Look for future events on our webinar calendar at fairfieldcounty.score.org. Some useful information about today. If you have a question, please use the chat window at any time during the presentation. It's located in the lower part of your screen. Our webinar will end promptly at 1 p.m. to respect your time. The session is being recorded, and the link to the recording will be available at our website within the next couple of days. Now our speaker, Joe McCaffrey, is a business advisor with Community Investment Corporation, which is a not-for-profit economic development lender licensed by the Small Business Administration to administer their lending programs. Welcome, Joe. I'll turn it over to you now.
Thank you, Tim. Good morning, everyone. It's a pleasure to be with you here all today. Again, my name is Joe McCaffrey. I'm a business advisor with Community Investment Corporation. I'll explain my duties and responsibilities a little later. I'm also a certified business mentor with Fairfield County SCORE and a subject matter expert in commercial real estate and small business financing. Over the next hour, I'm going to provide you with an in-depth look into the small business lending world. This is everything you need to know, or at least that I can think of, about getting money for your small business. As you're listening to this presentation, at one point or another, there will hopefully be a, yeah, that's me connection. I think there's something good in here for everyone. I'm going to give you a lot of helpful information. Don't worry about taking notes, just follow along, because as Tim said, the webinar is being recorded. You'll be able to play it back in case you miss anything. And just load questions into the chat box as you think about them, and we'll address them at the end, okay? So here we go. So as Tim mentioned, I'm going to start by giving you an overview of the small business lending world by telling you about the company I work for. Community Investment Corporation, it's a not-for-profit economic development lender, also known as a community lender. We're what's called a certified development company, or CDC. We tend to use a lot of acronyms in the small business lending world. You see what I mean as we go through this presentation. The Small Business Administration is the primary capital resource for startup and fledgling small businesses. We're licensed by the SBA to administer the loan programs. If you're a small business or looking to start a new business, the SBA is your best friend, particularly if you're looking to borrow money. You'll see what I'm talking about as we go through this presentation. CIC helps entrepreneurs get government-backed loans. The SBA doesn't make loans except for disaster loans. Banks and economic development lenders make loans, most of which are guaranteed by the SBA. Although CIC is affiliated with the federal government, we unfortunately do not offer any government grant programs. Our mission is to provide loans to the small business community, including disadvantaged borrowers and disadvantaged communities. There are other types of economic development lenders with slightly different missions. The first group is called Community Development Financial Institutions, or CDFIs. This includes Capital for Change and Hartford Economic Development Corporation. There's also state and regional economic development lenders such as Community Economic Development Fund and Southeastern Connecticut Enterprise Region. These other lenders offer different loan programs, including SBA and non-SBA loans. Some of them also provide grants, usually for specific purposes or in targeted geographic areas. Serving disadvantaged borrowers and disadvantaged communities is more of a focus for these other economic development lenders. And as such, their underwriting standards and loan terms may be a little bit more friendly, particularly for people with credit challenges. At CIC, we use the SBA's underwriting standards for all of our loans, which is what I'm going to talk to you about today. The other lending organizations I just mentioned may have slightly different standard and processes, but they're all going to be substantially similar. Okay, let's move on. So we finance all types of small businesses as long as they meet the SBA's size standards, which vary greatly depending upon the type of business. Classification is based on annual revenue and the number of employees. The maximum limits to be considered a small business are actually quite large if you take a look at them. For certain types of, whoops, where'd I go? Sorry. wrong thing. For certain types of SBA loans, including some of the most popular ones, which I'll talk about in a few minutes, eligibility is also dependent on the business's tangible net worth and net after-tax income. The upper limits are 15 million in tangible net worth, 5 million in net after-tax income for the prior 2 years. These limits are increased in areas with high unemployment or if the areas experience adverse economic changes, such as a natural disaster. In that case, it goes up by 25%. So as you can see, you can be pretty big and still be considered a small business for government financing purposes. Certain types of companies, even if they're considered to be small, do not qualify for SBA loans due to the nature of their business. This includes nonprofit ventures, although you may be able to get an SBA disaster loan. You do qualify for that. Investment companies, which is like a real estate developer or landlord, speculative prospecting, such as mining, gambling, businesses of an immoral or prurient nature are ineligible. Example that would be like a gentleman's club. Any business that is federally unlawful is a no-go. Although Connecticut legalized recreational marijuana this summer, it's still illegal under federal law. So if we have any budding potpreneurs on the call today, pun intended, sorry, I can't help you. Financiers such as payday lenders also excluded. Insurers are not allowed. Insurance agents are okay, that's fine. And other than that, all other businesses are eligible. These are the typical borrower profiles of who we work with. I'll use an aviation analogy to demonstrate this. We provide the fuel to power the airplane. Aspiring dreamers are still in the hangar, getting ready to head out to the tarmac. Startups are on the runway, starting to roll. Fledgling businesses are on the move, throttle down, wheels up, hoping to clear the mountain ahead. And established businesses are climbing to their cruising altitude. These 4 groups are the sort of businesses that economic development lenders help. The main requirement for getting a loan is that the business has to be at or near the point of producing revenue. And the reason, quite simply, is so you can afford to make the monthly loan payments. Depending upon the type of business, aspiring dreamers can still satisfy the revenue requirement. For example, someone's dream may be to open a coffee shop. The coffee shop will have immediate revenue as soon as they open their doors, so they qualify. Businesses that can't satisfy the revenue requirement will have to look elsewhere for capital, including the equity route, which I'm going to talk a little bit about later. SBA loans have what's called a credit elsewhere requirement. Certain types of SBA loans, including the SBA 7A loan, which is the most popular SBA loan program, are primarily offered by banks. So the business must be firmly established with a consistent track record of success in order to qualify for a bank 7A loan. For companies that are even more well established, they may be able to get a regular non-SBA loan directly from the bank. If you qualify for any type of bank loan, by all means, you should take it because the terms will be better than what economic development lenders will be able to offer you. The SBA doesn't want economic development lenders competing with banks. So in order to qualify for a loan of $20,000 or larger from an economic development lender, you first either have to be turned down or turned away by a bank. Therefore, the first place you should go when you're ready to shop for a loan is to your bank. If you're an aspiring dreamer, startup, fledgling business, or even a less than established mature business, the bank will probably refer you to an economic development lender like CIC. We get a lot of referrals from banks. If so, you'll be able to satisfy the credit elsewhere requirement. You don't have to actually apply for a loan and be denied. If the lender refers you elsewhere or nicely discourages you from applying for a loan, you'll be eligible for our loan programs. Economic development lenders serve the not yet bankable and disadvantaged populations who wouldn't otherwise be able to get a loan. The reality is that many small businesses will not be able to qualify for a bank loan. So economic developers become economic development lenders become the lender of last resort for many of these borrowers. We're it unless you care to venture into the alternative lending market. And again, I'm going to cover that a little bit later. On the other hand, we direct some borrowers back to banks because they're too good for us. We serve a narrow band of what I call Goldilocks borrowers. Not too good, not too bad. You have to be just right. As the term implies, SBA loans are for borrowers who can't get credit elsewhere. Even though the business doesn't qualify for a bank loan, many are still good B, maybe C plus quality borrowers. These are the people who we help. And the goal of our lending program is to see your business eventually graduate, whereby you can get a bank loan. Think of this as like a trial loan. It's our loans provide an opportunity for your business to prove your mettle. We report your payment activity to the credit bureau. So these loans actually help you build credit. I'm going to talk about credit in another few minutes here. Like banks, economic development lenders are risk averse, so the vetting process is going to be rigorous. You're not going to be able to get a loan from anyone unless you can demonstrate with a fair degree of certainty that you're going to be able to pay it back. Economic developers, lenders want your business to succeed. They're not going to set you up to fail because, as the name implies, economic development lenders seek to finance businesses that will have a positive economic impact in their local community. Our mission is to make loans that are likely to result in jobs, development of new skills, construction, paying taxes. Yes, paying taxes, that's a good thing, and serving as a magnet or feeder for other businesses. This is important to keep in mind. Economic development lenders fund opportunities, not distress, disaster, rescue, or bailout situations. The federal and state governments have plenty of assistance programs to help struggling businesses, such as the Economic Injury Disaster Loan, the Paycheck Protection Program, the Restaurant Relief Fund, and the Shuttered Venue Operators Grant. There's also the Connecticut CARES Act grant. Keeping a struggling business afloat while arguably good for the economy is not consistent with our mission, unless you have a really compelling turnaround strategy with lots of upside potential. Let's see, most of the loans are used for things like paying general operating expenses, purchasing inventory, wages, furniture, fixtures, equipment, machinery, construction, buying a business, buying real estate. We offer my company I work for, CIC, offers 4 different types of loan programs to meet your capital needs. And they, by the way, they can be combined. You can use multiple loans. The first is the SBA Micro Loan, very popular program. This is particularly for startup and fledgling small businesses. You can borrow between $5,000 and $50,000. It's on a 5-year payback. The fixed interest rate at CIC is 7.75%. There's no prepayment penalty. Established businesses with good credit can borrow up to $15,000 with a 2-week approval turnaround under the Micro Now program. You can use a micro loan to finance just about anything, except you can't buy real estate. That's the only thing you can't do with it. Not that there's any real estate in Fairfield County that you can buy for $50,000, so you don't have to worry about that. The next loan program we have is the COVID Pivot Program. So the COVID Pivot Program was money that we got from the Economic Development Administration. They'd given us this money about a year ago and said, hey, go help businesses that have been impacted by COVID. So this is where we use this loan program from. EDA is part of the Department of Commerce. Again, this is not for status quo bailouts. It's for loans to provide COVID impacted turnaround assistance for businesses. You have to be located in the western half of Connecticut, which includes all of Fairfield County, so we're fine there. If you're a startup, you can qualify for this loan if the business was started in response to either an opportunity or disruption caused by COVID. For instance, somebody starting a business because they lost their job due to the pandemic. We have a lot of flexibility on the terms for these loans, so they're custom tailored to each borrower. If you qualify, the terms are very favorable, and they're usually better than the SBA loans. Again, the primary purpose of our loans is to provide economic development assistance, so we'll work with you as much as we can to try to help you out. Next, okay. SBA microloans and EDA COVID loans are part of CIC's community lending program. Community lending is unique because not only do you get the money you need for your business, you also get a free business advisor, and that's what I do, in addition to screening inbound loan originations. I coach applicants through the loan approval process, and then after they get their money, I help them optimize their business over the life of the loan. My job is to help each of the borrower's business be the very best it can possibly be. TA is similar to the advisory services provided by our economic development partners, including our host for today's webinar, SCORE. We regularly collaborate with organizations like SCORE, referring clients to and from one another. CIC also offers an SBA 7 loan, which is the exact same SBA 7A loan that are offered by banks. Our 7A loan is called a Community Advantage loan. The only difference is that the Community Advantage 7A loan is only available for businesses that can't get a bank 7A. You can borrow up to $250,000. By the way, bank 7As go up to $5 million. The payback period is usually 7 to 10 years. It has a 7% variable interest rate. It's tied to prime, and there's no prepayment penalty. You can use this loan to buy commercial real estate for use by the business. And for larger real estate purchases, we have the SBA 504 loan. This loan is used to purchase fixed assets, such as real estate, heavy, non-movable equipment and machinery. You can borrow up to $5 million for up to 25 years. It's the 25-year loan rate right now is 3.2%. Fixed rate of interest just went up. It was 2.98, went up to 3.2. You only have to put as little as 10% down. There's no balloon, but there is a prepayment penalty if you pay it off early. These loans are pooled and sold to long-term investors who want a steady income stream. So they don't actually want you to pay it off early. The way this loan works is that the borrower puts up 10% of the money. The CDC puts up 40% on behalf of the SBA, which would be my company. And we need a bank partner to provide the other 50% of the funding. It's essentially two loans in one. And we'll work with your bank, or if they're not interested in doing the deal, we'll help you find another bank that is. Okay, so let's talk about the requirements for securing a loan. I'm going to give you an overview of the credit underwriting process. I call this the 7 C's of capital. Some people have 5 C's, others have 6. I have 7. I'll go through all 7 with you. Economic development lenders look at the entire picture when evaluating new loan opportunities, starting with the borrower's credit profile, which applies to the borrower and their spouse, even if their spouse isn't involved in the business. The first thing we look at is the credit score. Credit score is a barometer of the borrower's ability to responsibly manage their money. We look at your personal credit score because these loans require a personal guarantee. Limited liability doesn't apply when you borrow money. Likewise, if you enter into an asset lease, they're going to want a personal guarantee, which means they're going to check your credit. We pull credit reports from 3 major agencies, which includes Experian, Equifax, and TransUnion. We use a simple average from the 3 agencies for all owners who have at least a 20% interest in the business. The average credit score should be at least 600 or 675 for a micro now loan. Credit score is very important if you're looking to get an SBA loan. That being said, CDFIs are less sensitive to credit scores. So if you decide to go that route, that might be good for you. In some cases, they don't even look at your credit score. So if you're seeking an SBA credit, however, work to get your score. Ideally, I would say north of 650 before you apply. That's going to give you the best chance of getting approved. Having a poor credit score is the biggest obstacle I see when people are trying to get a loan. Maybe your credit score is low because you don't have a lot of credit, as opposed to having bad credit because you missed payments. There are things you can do, though, to improve your credit score. Fairfield County SCORE is hosting a credit webinar next Friday on the 22nd with a professional credit counselor who can give you more information about this. It's definitely worth checking out. In fact, I'm going to be tuning in myself. In life, you can't have too many friends, too much money, and you can't have too high of a credit score. So optimizing your credit score should be a never-ending pursuit for everyone. Again, we report your loan payments to at least one of the credit bureaus, so your on-time payment history with us will improve your future credit score. Let's see. As part of your credit profile, we also look at your payment history. We want to see that you're current on all your debts and bills, both business and personal. You can carry a balance, but you can't be late on the payments. Likewise, we don't like to see write-offs, defaults, particularly on federal obligations such as government loans or taxes, and you can't have a bankruptcy in the last 10 years. Capacity is a measure of your ability to make the loan payments. We look at your financial statements if you have an existing business, which includes the profit and loss statement, cash flow statement. We also look at 3 years of income taxes. As part of our review, we do a tax return reconciliation to compare what you say your income was on your P&L and what you reported to the government. Having undeclared income is the same as having no income. If it's not on your taxes, we're not going to look at it. We also want to see your balance sheet. We'll look at the book value of your assets versus the market value. If you're buying an existing business, we look at the amount of what's called goodwill, which is the difference between the book value of the assets and what you're paying for the business. If there's a lot of goodwill, there's going to have to be a good reason for it. We also like to see an emergency reserve of liquid cash in case the business needs some extra money. It's like a cash cushion. Under the liability section, we want to see a complete schedule of debts. Remember, a PPP loan is still a loan until it's forgiven. And we also want to see that the business is taking advantage of all available grants and stimulus programs. By the way, an SBA EIDL loan, the EIDL, is the cheapest money you're ever going to be able to borrow. So if you qualify, and assuming it's for allowable purposes, I do an EIDL loan before looking to take out any other loan. We also look at the ratio of accounts payable versus receivable. We're sensitive to things like contingent liabilities, lawsuits, that sort of stuff. Getting divorced counts as a lawsuit, by the way. That's litigation. Divorce can be very expensive and it can wreak havoc on a business. I mentioned previously that if you're married, your spouse will be involved in the credit review process, even if they're not involved in the business. This can be a positive or negative if you're about to get married. I counsel a lot of clients who are in that situation. We also want to see realistic financial projections. Next slide here. For the business, particularly for startups, the viability of the business is a function of these projections. The loan has to what we call cash flow, which means the projected bottom line has to be adequate to satisfy the debt. The stabilized cash flow must be adequate to pay 120% of the principal and interest payments. That's called the debt coverage ratio. We also look at other supporting income. It helps if you have a day job or a working spouse. You need to be able to cover your household and living expenses. We don't want you to be homeless or starving while you're doing your business. And at some point, the business should provide an appropriate compensation for the owners. We look at the big picture. We don't want to put you in a loan that you can't afford. This is a good example of why economic development lenders are the complete opposite of predatory lenders. We're only going to give you a loan if we believe it's best for both of us. The economic development lending program only works if our loans that we make remain performing. Okay, next is collateral, which is security for the loan. Typically, these are secured loans. To the extent that collateral is available, we're going to want you to pledge it. Again, these loans require personal guarantee, so we're going to look at your assets, which includes the business. Capital-intensive businesses with fixed tangible assets are preferred. Fixed assets provide better collateral than things like furniture, fixtures, and equipment. If you can, try to minimize the amount of the loan proceeds that will be used for working capital because there's nothing for us to attach the money to. Likewise, if you have personal assets like houses, non-retirement investment accounts, vehicles, the lender probably will want to use some of those as security for the loan. You may be wondering, what about a cosigner? Sorry, we don't permit this. Anyone who owns 20% or more of the business has to sign the loan. That's the only way you can bring other guarantors into the equation. Assignment of life insurance may be required depending upon the loan size. The owner is key to the success of the business, so lenders have an interest in you staying alive. Proof of COVID vaccination is presently not a prerequisite for getting a government-sponsored loan. Who knows what might happen in the future? As you know, we live in a world of constant and rapid changes. As I just mentioned, a lack of sufficient capital or collateral may not preclude you from being able to get a loan, but it sure helps if you have assets. Again, we look at the entire picture. Truth be known, we don't want to take the borrower's assets, but we will if we have to. We use collateral as an incentive to make sure the borrowers perform. As a borrower, you're essentially a stakeholder in this economic development lending system I've been talking about, because our ability to continue helping other businesses is contingent on existing borrowers paying us back the money we loan to them. Although some, but not all of our loans are partially or mostly guaranteed by the government, we operate at or near break even, so we can't afford to incur any losses. We need you to pay the loan on time. Okay, character, which is a measure of what sort of person you are. We look at things like a criminal record. Honesty and transparency are important here. If you have any experience with the criminal justice system, our researchers will find out about it, I guarantee it. Even things that were supposedly expunged. We do an extensive background check as part of our due diligence, and we don't like surprises. So having a criminal record may not preclude you from getting a loan, except for crimes involving fraud and children. Speaking of which, child support payments must be current, and we check references, both personal and professional. Having an existing relationship with the lender always helps. We like to do business with people who we already know. Remember, money is a relationship business. It's not transactional. So cultivate the relationship you have with your lender. This will work to your advantage when you're ready to move your business to the next level and you need more money to do it. Number 5, we're almost there, hang with me. is demonstrated commitment. Lenders in particular are ultra risk averse, so their money is always going to go in last. We want to see a personal investment, which means the borrower's money goes in first. Typically, what we like to see is that you've contributed 20% of whatever the amount is that you're borrowing. This is referred to as an equity injection. Think of it as being similar to a down payment. The investment of your time, while valuable, doesn't count. We prefer to see the borrower's investment be for tangible assets like equipment, as opposed to soft costs like professional fees. You can borrow money for the equity injection as long as the cost is included in the financial projections. Friends and family contributions look good. It helps to have a vote of confidence from the people who know you best. Another thing we look that looks good is grant awards from other organizations. Folks, there's no such thing as starting a business with no money down. You need money to make money. Sometimes you need more money than you're able to save on your own. Think about where can you get help? You may need more help than a lender will be able to provide you. I'll tell you this, self-made success is a fallacy. Nobody achieves greatness on their own. Okay, next is you need to have a compelling story. This is important. We have limited pools of capital and human resources, so we can't process every loan request we receive. We only take the best. Your story is essentially the answer to this question. Why should we do this loan? How does it satisfy our economic development objective? This is where your business plan comes into play. Describe your vision, explain the unrealized opportunities, how you came up with the idea for the business. A business plan is a tool to not only help the business owner clarify their future vision, it's a way to get their audience excited about their story. A business plan uses words to tell the story, whereas the financial projections use numbers, but the story that each tells should be the same. We refer a lot of our clients to SBA resource partners like SCORE for help with developing business plans. If appropriate, describe the turnaround plan. Most people see challenges as problems. Entrepreneurs see challenges as opportunities to make things better. That's what makes them unique. Entrepreneurs focus on figuring out and delivering solutions to problems. If the thought of that excites you, then you have an entrepreneurial spirit. Another thing we look at is the experience of the business owner. Maybe you don't have direct experience in the business you want to do, but you've likely developed skills in previous jobs that are transferable. Help us make that connection by describing and explaining how your past experiences qualify you to run this business. We like to see people with a history of success because that shows you have high earnings potential. If you've been in business for a while, that certainly helps because you can demonstrate direct experience. If your new business is a departure from your past experience, go work for somebody else. So at least you have knowledge of the industry. We're also going to look at your online profile. That includes your business website, social media, blogs, etc. If your business requires licensing or certification, it helps to have that before you apply for the loan. All of this, again, tells your story. You need to have a good story. Once all your information is assembled, we assign a loan officer to help you get the loan approved. And it's the responsibility of the loan officer to build what's called a business case, which is a 5 to 10 minute summary of the borrower's story that he or she presents to our board of directors for approval. And finally, getting a loan requires confidence. The lenders need to have confidence in the business, not only in the ability to service the debt, but contribute to our economic development mission. We want our clients to be successful, so we have to be confident in what they're doing. We also have to be confident in the people running the business. Keep in mind, the business itself is inanimate. We're loaning the money to a person. In this race, we're betting on the jockey more so than the horse. The business owner should also have confidence in their ability to be successful. One of the things I always look for is people with the heart of a champion. We want to help businesses and people who are confident that they'll be successful. Okay, so there you have it, the 7 C's of capital. Again, economic development lenders look at the entire picture when evaluating new loan opportunities. Think of the 7 C's as a mosaic of individual color tiles that form an overall picture. Okay, so let's talk about the process of applying for a loan. The first step is where we collect all the information we'll need. Specific requests for information will vary depending upon the type of loan, but we always start off with going through the qualification screening questions. In addition to providing TA services, this is also what I do for CIC. This webinar, in fact, is essentially a summary of the screening questions that we ask. In the interest of not wasting people's time, we try to provide a quick no to businesses that aren't likely to qualify for a loan. These are government loans, which means there's a lot of paperwork involved. We're talking lots and lots of forms to fill out, including the application. There's also the personal financial statement. This is where you're going to list all your assets, liabilities, income, all the things I mentioned during the overview of the 7 C's. Again, these are secured loans and you're going to have to provide a personal guarantee. There's no such thing as limited liability when you borrow money. Another form is the credit check authorization. The first thing the lender is going to do when all the information is submitted for processing is pull credit. You can check your credit score through your financial institution, and a lot of banks have this. You see something on there, your FICO score. Credit monitoring services like Credit Karma, I know a lot of people use, or you can get a free credit report each year from a website, freecreditreport.com. If the loan request gets denied, we have to wait 6 months before we can resubmit it. So make sure you're good with your credit score before we submit it. We want to see financial records for the borrower and prior business owner if applicable. This includes taxes, P&L, balance sheet. We'll need a copy of the business plan and financial projections, obviously, if it's a startup or fledgling business. They'll ask for various legal documents like the purchase and sale agreement if you're buying real estate, or the lease. By the way, the lease has to be at least as long as the loan, including renewal options. Other real estate documents that may eventually be needed include an appraisal, phase 1 and maybe phase 2 environmental reports, and a historic property clearance. If you have customer orders and contracts, that's helpful to see. If it's a franchise business, they want to see a copy of the franchise agreement. There's other information we'll need, I'm sure, but this gives you a general idea of what's going to be needed. I went backwards. Okay, here we go. Next step in the process is underwriting, also known as credit. This is where the vetting process takes place to see if the business is financially viable, on paper at least. All of the information we collected is examined and analyzed. This is the beginning of the business case analysis that I mentioned, right? This part of the process takes place mostly behind the scenes unless there are questions. Again, it's a rigorous process. If the loan survives the credit process, the odds are good that it will get approved, which is the next step in the process here. The credit review team includes the underwriters and the loan officers. They come to a collective agreement to move the loan along to the next step in the process, which is where the loan package gets presented to the board of directors. Everything we collected, all the work we did, is condensed into a 10-minute presentation to the board delivered by the loan officer. The rest of the loan team, including the underwriters, are present to answer any questions that the board members might have about the opportunity. It's a true team effort. If the loan's an SBA 7A or 504, we also need to put together a package of information to send to the SBA after we get the board's approval. This adds 2 to 3 weeks of time to the process. The SBA guarantees these loans, which is why they have veto rights. We have to make sure that the loan package conforms to all of their standards and practices. SBA standard operating procedure reads like the Internal Revenue Code. There's a lot of rules and regulations. It's not easy to get these loans approved. Let me tell you, it's a lot of work. And you really have to know what you're doing. And this is the value that economic development lenders provide. They know how to get these loans approved. If the SBA denies the loan, they issue what's called a screen out. This is a formal document that describes the reasons why they're denying the loan. We have an opportunity to address their concerns and resubmit the package, and that's going to add another few weeks to the process. We have a very low screen out rate at CIC, which is important. There's a tremendous amount of work that goes into developing a loan package by the borrower and the lender. And we don't want to come up blank. I mean, it's terrible when it happens in rare instances, but not often, where we get denied. The final step of the process is the closing. There will be more documents and forms to fill out, insurance certificates, filing of liens, all that kind of stuff. The entire process, it takes time. Figure it'll take 2 to 3 months from start to finish for most loans. If you're doing an SBA 504 loan, that's going to take a little bit longer because there's more due diligence involved. Could take even longer if we encounter any problems along the way, like a screen out, as I mentioned. There's also environmental contamination, or we get a low appraisal. I'll say this: if you're in a rush, SBA loans are probably not a good alternative for you. If possible, you want to begin this process as early as you can. Okay, I'm going to skip over. How are we doing on time here? Actually, I can go through this. We're good on time here. So here's some additional suggestions that might be helpful for you. It seems obvious, but don't borrow money unless you're certain you can pay it back, because Uncle Sam has long arms, and the default remedies are not pleasant. So make sure you're able to afford the loan. Always try to get the bank loan first, because it's going to always be cheaper by at least 1%. It's generally easy to get a loan when you're first starting out than it is to get more money after you've been operating, because projections are usually rosier than actual results. So be sure you have enough capital to get you through to the point of cash flow stabilization. Everything always takes longer and costs more than you think it will, so plan for those realities. Time is of the essence, particularly when you're first starting out. Remember the airplane analogy with the mountain ahead, right? Focus on making sales and don't get distracted by non-essential activities. Working capital, that's the greatest financing need of small businesses, and certain types of businesses need more working capital than others. Using a term loan for working capital, like say an SBA micro loan, is not really a great substitute for a line of credit because working capital needs ebb and flow. What I mean is the balance goes up and down over time, whereas the term loan is constant. Once you borrow the money on a term loan, you're paying for it whether you use it or not. Most banks will give established businesses a credit card, and in time, after you use it responsibly, you can hopefully apply for a traditional bank line of credit. That should be your goal, is to be able to get a bank line of credit. Automotive dealers, they usually are going to give you better terms if you're buying a vehicle than using one of these loans. Any kind of seller financing for any asset has the added incentive of helping the seller make the sale, so they're going to be willing to give you better terms. Don't forget about leasing. Leasing is a form of financing. It's usually cheaper than buying because you only pay for what you use. And if you have a business where assets are subject to functional obsolescence, leasing is a better way to go because you can turn it back at the end and you don't have to worry about it. Okay, now we're going to go into the other sources of capital. If you can't get a loan or if you don't want to take on debt, other potential sources of capital may be available. Clients of mine have attempted to utilize every one of these ideas with mixed results. Some of them are obviously going to be better than others. So I would say, proceed at your discretion. Remember this, when considering the cost of capital, recognize that in addition to any direct costs, there's an opportunity cost associated with every money source. You're going to give up something and it may be greater, in some cases far greater than what you gain. So make sure you go into it with eyes wide open so you understand all the pluses and minuses. In many cases, the best course of action is going to come down to a personal decision. There may not be a right or wrong choice. You're making the best choice for your individual situation. You have to live with the decision, so do what makes you feel most comfortable. All right, so here's the list of alternative sources. You may be able to invest some or all of your retirement savings in your business. It's risky. Financial advisors would probably advise against this because it creates the opposite effect of diversification. I do know some people who've done it though. The people who love you may be more generous and forgiving. So I have a client whose family provided an advance on a future inheritance they used in their business. Again, these are just some alternative ideas just to give you, just to get you thinking. Believe it or not, there are benevolent people in this world who just want to help other people. And someone, they may like you, they may like your business, and they generously want to help you. This actually happened to one of my clients. She had a customer who loved her products, loved her story, wanted to help her succeed. So she purchased equipment that was needed to expand her business. It was tremendous. Crowdsourcing is similar. There's oftentimes a social element to these campaigns where, again, people want to help you. And sometimes they receive free or reduced price products or services in return, as opposed to equity. That seems to be, the way that those are commonly done. Keep moving the wrong thing here. Sorry about that. I'm not aware of many, but there are grant programs, including matching grants and forgivable loans. One of my manufacturing clients received a matching grant from the Connecticut Center for Advanced Technology, where their match money was funded by a loan from CIC. Okay, so they were able to expand their business and they didn't have to put up any money to do it. So that was nice. Some organizations, including foundations, sponsor business plan competitions where the prize is a grant to help advance your business. There's that as an opportunity. And once you've been in business for a few years, and if you do a lot of credit card transactions, your credit card processing company will probably offer you an advance on your future receivables. This is called factoring, and it's comparable to selling your blood. I would just say be very careful if you decide to do that. By the way, if you have a SBA loan and you pledge the assets of your business, your future receivables are considered an asset of your business, and therefore you won't be able to do factoring without violating the terms of your loan. A HELOC, home equity line of credit, may be a cheaper alternative to an SBA loan. You probably be pledging your house as collateral anyway. You're thinking, right? So why not just do that? It's going to be a cheaper interest rate. True, the only downside is that you won't be building credit in the name of the business. In time, your business will have its own credit score. Dun & Bradstreet does this. Until then, your personal credit score is going to be the sole benchmark of your financial management prowess. Fintech primarily includes online lenders. All I can say with this is proceed with caution. These are very high interest loans. I heard of someone recently who was charged 30% interest. I'm not making that up. So, take that for whatever it's worth. Similarly, there are loan sharks. They really do exist. I know clients who have used these loans as bridge financing to close deals. I would just say be careful because sometimes these loans are secured by your kneecaps. Another option is to bring on operating partners. It's like creating a marriage. A long courtship should precede any commitment. Oftentimes, partners are friends or family members. If the business goes bad, the personal relationship oftentimes goes with it. So keep that in mind. If you bring in additional owners, accountability increases. You're no longer in business just for yourself. These people now have a say in your business, regardless of their ownership percentage. And sometimes they speak very loudly. So, just something else you're going to have to deal with. The biggest conflict I've seen in these situations is that operating partners wear two hats. First, they're owners and they're also workers. Owners are entitled to their proportionate share of profits after the workers have been paid. There may be an equal partnership. Let's say you have 4 partners, everybody's 25, 25, et cetera. But that doesn't mean that the work that each person does is equal. Workers need to be paid a market wage for their labor, and whatever's left over goes to the partners. There's also not so silent equity partners. They may not have a role in the day-to-day affairs of the business, but you can bet they're going to have a lot of opinions about things, and they're not going to be shy about expressing them. Examples would include angel investors. We're fortunate that we have a lot of these in our area. If you do a Google search for local angel groups, you'll see what I mean. I did this the other day, and I found a couple. I'll let you know what they are: Angel Capital Association, Angel Investor Forum, and Connecticut Angel Guild. I don't know anything about these. I've never worked with them, but I figured I'd share those names if you want to check them out. The best place to find angel investors is within your universe of stakeholders, who are the people that already know and trust you. If your business is more established, there's also venture capitalists. Connecticut Innovations is the state-supported VC group in Connecticut. We sometimes get referrals from them. I haven't worked with them or know anybody who has, but I know that they do exist. And there's also our friends at the SBA. There's a classification called a small business investment company, or SBIC. Similar to how a CDC partners with a bank on a 504 loan, SBICs do the same thing, except with equity instead of debt, or maybe a mix of both equity and debt. So again, they bring in equity partners to help you get the money that you need for your business. There's also the Small Business Innovation Research, which goes by the acronym SBIR, Small Business Technology Transfer, STTR. They have these programs. These are high-tech research and development programs. These are administered by the federal government, by the way. In order to qualify, you need to do something extraordinary and groundbreaking, like you've come up with a cure for COVID. I mean, it's to that level. As I've shown you, there's alternatives to taking out debt. Sometimes it makes more sense to pursue equity rather than debt. For instance, when the viability of the new product or service is unproven, or if it's an uncertain market, that's an equity play. Likewise, if you're still in product development, or if the expectation of revenue is sometime in the future, that's again an equity play. If you have a large capital need for operating expenses, we're talking like millions, you're going to need equity investors. Equity capital is for high risk, high reward opportunities. In other words, companies with a lot of upside potential. The business has to be pretty darn good in order to be able to attract equity investors. And you need to have more than just an idea. Can anyone think of any other potential sources to share with the group? If so, post it in the chat box, but that's pretty much all the ones that I can think of. Okay, I've given you a lot of ideas for how to get money for your small business. Did you see your situation in this presentation? Was there a that's me moment? Hopefully there was. Again, the mission of economic development lenders is to help small businesses succeed. Admittedly, starting a business, it can be a little scary. Remember though, you're in business for yourself, but not by yourself. There's a lot of resources to help you, including SCORE, and I encourage you to take advantage of them. Do you understand now why I said the SBA is the small business owner's best friend? You've heard the old saying, we're from the government, we're here to help you. Well, in this case, it really is true. Okay, that's it. I just gave you 2 webinars for the price of 1. Thank you for your time and attention. Today's webinar has been brought to you by Community Investment Corporation. We help small businesses get government-backed loans. There's my contact information. If I can help you with anything, you can reach out to me. And before I turn it back over to Tim, let me just say first, thank you to First County Bank for sponsoring this webinar and Fairfield County SCORE for hosting it. And we've got about 15 minutes for questions, but first, Tim, take it away.
Thanks. Thanks, Joe. I know you had to do a lot of fast talking to jam it all in. This was an excellent job. Good job.
Thank you.
We'll now use the remaining time for Q&A. We'll take as many as we can to up till 1 o'clock. So please submit them via the chat feature in the lower portion of your screen. We do have a few that have come in already. The first one from Julie. What do you recommend for reserve? Is it 3 months or is it more than 3 months? What should the reserve be?
So we're talking about like the cash cushion here. You know, I'd say it really depends on the business. Like startups obviously are not going to be required to post more. I mean, if you could do 3 months, yeah, that would be great. See, here's the way it works. When we look at the financial projections, we ask for a 24-month financial projection. And the reason why we want to see 24 months is because you know that there's going to be some seasonality or cyclicality to every type of business. You know, the revenue and expenses are going to vary, and there's going to be some months where maybe you're making a profit, some months where maybe you've got a little bit of a loss. And so what we do is we look at the cumulative effect of that bottom line. And we want to see like, what's the maximum amount of money that you may need to put into the business in order to keep the business afloat. So what that number might be, again, it depends on every business is going to be different. But I usually tell people when I'm going through the loan screening interview questions with them, you know, I know you're going to be putting most of your available money into the business, but I would say if you could show that you've got like, say, $10,000 in reserve that you can use for the business, in most cases, that'll probably be adequate. You have to show something. And, you know, in some cases, as I mentioned, people borrow that money to just, you know, maybe a family member, a friend. They're not going to put it into the business unless it's needed. It'll just sit in a bank account, but at least they have access to it if they need it. So there's ways to get around that.
Great. Two things. Why don't you go back to your contact information? We have and leave that up during the Q&A, I guess, because there are people that want your contact information. And then they would like you to talk about micro loans.
Mm-hmm. Yeah, micro loans, like I said, micro loans are the most popular loan program that we use for startups. And it's these loans, unlike the other loans that have government guarantees, there is no government guarantee on the SBA Micro Loan. We borrow that money from the federal government, and then we loan it to small businesses. And those loans stay on our books. So that's why we provide the technical assistance program, is because we have a vested interest in the success of your business, which is a good thing. You have somebody there, you know, a team of people who are helping you make sure that your business is going to be successful. The team includes me, includes the loan officer, and everybody else at CIC. We want to see your business succeed. So that's mostly, you know, the most unique part of the microloan program is that TA service. It's really a great thing for small businesses. So again, it's between 5,000 and 50,000. The loan term will be anywhere from 3 to 5 years. We try to stretch it out as much as we can because then the loan payments are less. I just want to talk a little bit more about the micro loan program. If you've been in business for at least a year, you're current on all your debts and bills, and you have at least a 675 credit score, you can get up to $15,000, like I said, with usually about a 2.5 week turnaround. And that's a big plus because, as I mentioned, some of these loans may take 2 to 3 months to get approved. So if you can get some money for a quick project, I mentioned you can combine loans too. Like we sometimes will pair a micro now with like a community advantage loan because somebody needs an immediate, you know, boost of money to get a project going. And then when we close on the other loan, they can fund the rest of it. So again, we can mix and match these things and use them in combination.
Got it. Next question was, will CDC entertain financing service providers who are consulting organizations for nonprofits?
If you're consulting for nonprofits, yeah, I mean, as long as your business is revenue producing and it's a for-profit enterprise, then absolutely, sure, we could look at that. Here's the ironic and funny part about this: the SBA won't provide financing to nonprofits, yet my company is a not-for-profit. So we couldn't borrow money from the SBA for one of their loan programs if we needed it. So again, it's a little bit of an ironic, you know, controversy, but it is what it is. I mean, we don't make the rules. We just adhere to them. But yes, definitely we could, as long as your business is for profit, revenue producing or near revenue, as I mentioned earlier in the presentation, we can help you.
Next question from Christopher is, how long is a typical business plan that you accept? And I can identify with this because I've seen so many different software packages out there, different lengths.
So in terms of like how many pages in the document,
Right.
I would say on the short end, it's usually 10 pages. You can get your point across in 10 pages. I've seen other ones that are 30 or more pages. And I would say it's more of the quality of the content more so than the quantity. That's really what we're looking for. Like I'll go back to the example of a coffee shop. If you're opening a coffee shop, you don't need to tell me about your coffee shop in 30 pages because to be honest, I really don't want to read 30 pages about your coffee shop. 10 will do. That'll be fine. If you've got a business that's a little bit more involved or a little bit more unique, well then yes, you'd want to explain in a little bit more depth, and it'll require a little bit more space to do that. But again, it isn't going to earn you brownie points if you submit a 25-page business plan. It's just more stuff that somebody has to read. So make the point and as much space as you need, but you don't have to go overboard.
Right. Greg's asking, doesn't your credit go down every time you pull a credit report? And by how much does it usually go down?
Yes, it does. That's a good question. And that was one of the questions. Somebody had submitted some questions beforehand. So, it does, but it's only temporary. Shopping for credit, when it looks like you're shopping for credit, that increases your risk profile. So the credit agencies are going to cut you back a little until the uncertainty is defined. I'd say in most cases it's 10, 15, maybe 20 points. It's not usually going to be that much. And at least until the uncertainty is defined. And here's another thing, if you're shopping through multiple lenders, which most people do, try to concentrate the inquiries around the same time, because the credit agencies will recognize that you're shopping and they won't cumulatively whack your score. You don't want to get hit, 10 points every time you have somebody check your score. Next thing you know, you're down 50 points. So try to do that if possible. But again, it's only temporary. I'd say it lasts maybe a month, maybe two, and then it'll go back to where it was, assuming there's no other material changes in your credit profile. But I generally tell people it's not worth getting excited or worrying about. By the way, just for comparative purposes, 700 is around the average national credit score. So, you can benchmark where your score is relative to that average. The top score you can get is 850. I've never met anybody with an 850. Some people close, but never perfect. There's no such thing as perfect, at least that I know of. There might be, but yeah, that's again, it's temporary. I wouldn't worry about it. It's not gonna tip the scale in either direction for you.
Got it. We have another question. If you're approved for a micro loan, is the first payment on the loan due 30 days after you initially get the money, or is there like a waiting time, like 60 days before the first payment needs to be made?
Generally, it's 30 days later. You get the money, and it's called an ordinary annuity, where the payments are made at it's kind of like a mortgage, right? Leases, by the way, are called annuity due, which is you pay at the beginning of the period, but I'm getting a little finance geeky with you there. But yes, you normally the first payment is 30 days after the loan starts. Now, that being said, if you need some extra time, I mentioned on the COVID EDA loan, we've got a lot of flexibility on that particular loan, where we could potentially give you a period of interest only, or in a rare case, maybe you don't pay anything for a period of time. We let the interest accrue. Again, very, very rare cases we might consider doing that. But on the micro loan, we have a little bit of flexibility there. I'll give you a little inside information. I said the micro loan term can go up to 5 years. It actually can go up to 6 years. That's the maximum permitted term for a micro loan. We only do 5 because we want to leave ourselves a little bit of extra time if, at the beginning perhaps, or even over the course of the loan, if we have to, work with you to give you a little extra time on some things, we have the flexibility to do that.
Right. Someone's asking, if you decide to pursue an equity investor, what are the private investors really looking for? Anything different than you?
It's, a part of the presentation that I wanted to do today was to give you a general overview of not just what it's like to get a loan, an SBA loan, but the entire, capital process in general. There may be some specific things that are particular to just loans, but, everything that I covered here today are good best practices principles that you should be, trying to implement in your business, regardless of what type of capital you're looking for. So I think the short answer is many of the things that we're looking for, like, I used the term, the heart of a champion. Yeah, that's what they want to see. They want to, they're, same thing. They're betting on the jockey, not the horse. They want it. They want good people who are going to, be successful. That's, a bigger part perhaps of the equity capital side, even more so than on the debt side. So yeah, everything here is applicable no matter what type of capital source you're looking to tap into.
Yeah. Another one wanted your opinion of fintech loans because their experience is that Square Capital, they've heard, will very often make weekly payments of 6% of your revenues. And they are more like loan sharks is the question, I guess.
Well, I paired the two, one preceded the other, right? So, I mean, they're kind of, to me, I've never heard anybody who has had an experience with a fintech lender be anything other than like, wow, that was really expensive, and in some cases, regret for having entered into it. But at the same time, listen, I mean, the reality is that some people are desperate and you need money, and they're there and they're willing to give it to you. So there's a cost, and like the loan sharks, the people I know who've used it's a term. I mean, it's basically somebody who charges a very high rate of interest for a very short period of time, and they just needed the money for a really short period of time. They didn't mind paying it because in one case, a guy was going to lose a property that he didn't want to lose, and he needed the money to secure the property, and just said, you know what, I'm going to do this even though it's expensive, but I don't want to lose this property. So there's reasons for why you might do it, and I understand those reasons. And again, this is why I mentioned it's a personal decision. It's not a matter of me or anybody else saying you shouldn't do that or you should. You have to decide what's best for you, and understanding, going into it with eyes wide open and understanding what you're getting into.
Got it. Very good, Joe. That's all the time we have for questions. As a reminder, a recording of this webinar is available within a day or so at our website on fairfieldcounty.score.org. If you missed something, go back, rewatch it as many times as you want. Please check out our website for more events coming up. I believe within this month, we have one on crowdfunding, if that was something you're interested in as well. Again, SCORE offers free individual counseling, so please use the link on the screen. Well, it's not there, but you can go to our website. We're available for sessions via phone, email, or video. Also, please fill out your evaluations that have been sent or will be sent shortly. On behalf of SCORE and our sponsor, First County Bank, I'd like to thank you all for attending today's SCORE live webinar. In closing, a big thank you to Joe McCaffrey. Thanks a lot, Joe. That was great.
Thank you. Appreciate the opportunity.